This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the Young Wealth Show, where you'll truly learn how to make, spend, and invest money for an awesome life. Get the real-life stuff that wasn't part of your school curriculum. Young Wealth gives you innovative new ways of dealing with your finances, as well as the skills and tools you're going to need to survive and be successful out on your own. Let the Young Wealth Show be your GPS to take you from clueless to clued in. Here's your host, Jason Hartman, with Young Wealth.
It's my pleasure to welcome Ari Rastegar. He's the founder of Rastegar Property Company, and they do a lot of stuff, a lot of different investing, a lot of different sectors, but focus a lot on multifamily investing. So we'll talk about that today. Ari, welcome I know you're coming from Austin, so welcome. How are you?
Thank you so much. I appreciate you having me.
Good to have you. So what is going on with, we've heard a lot about rent collection issues and eviction moratoriums, and, we have had a lot of people concerned about that. But since we play mostly in the single family home space, it's like a non-issue. But I know it's more of an issue in the apartment space. Definitely was just reading an article this morning in Globe Street about that and how, collections were declining. One of the things that I don't think a lot of people realize, though, Ari, is that, collections are always an issue. That's just a normal course of business, right? So you never have 100% collections. Nobody has that.
Well, you call it, you have a vacancy rate. You factor in your underwriting always.
Yeah. So what is it looking like now? And, what are you guys doing? Are you working out deals with your tenants and so forth? Promise to pay deals, et cetera. Tell us about that.
Sure. I think you kind of got to bifurcate that conversation a little bit, as you said. So if you look at it at a macro level of the United States, at the height of COVID, still about 90% of rents were being collected in multifamily across the entire United States. 90% is a huge number when you're talking about a pandemic. In Austin, for us in particular, we collected 99% of our rents. In fact, we collected more of our rents at the same time during COVID than we did the previous year. And that had a lot to do with, people were staying home and they didn't know if they had their jobs. They want to make sure they have a roof over their head. And we collected that data through a series of surveys, talking to them. But Austin's a unicorn, right? So Austin is not, indicative of the rest of the United States or some other types of cities. And once you start digging into Class A versus vintage, and it starts to get a little bit more difficult. But in Texas as a whole, rents are collected in the mid-90s. And as you mentioned, most months you maybe have a tenant
in the mid 90%.
In the mid 90% of collections are paying. Absolutely. Sure. So when you start to see those numbers come down on an average basis, you're watching on the East Coast, the West Coast. New York City, as an example, this time last year had 5,600 vacant apartments. Right now they have 25,000 vacant apartments. So that number that's being pulled down is really in these larger primary markets like your San Francisco's, your Los Angeles's, and the New Yorks. But overall, multifamily, certainly in the Class B, Class C space and the value add space that we play in mostly, collections have been really strong, and so compared to retail or some of these other, or hospitality that have dropped completely off a cliff, there really have seen multifamily be a flight to security. And it's why you haven't seen cap rates expand as much as people thought they were going to, or see these, blood in the street type deals in markets, certainly in the Sun Belt, like in the Nashvilles, the Texas, the Florida, the Phoenix. It's fared really, really well. And, and
this is the problem. I'm battling this all the time. Like every time I post a video or do an interview on someone else's YouTube channel, you get these comments from these people that just don't know what they're talking about.
That's just not, this is the data. The data is that overall 90% of the collections in the entire United States are multifamily. That's an extraordinary number.
So everybody says, though, well, not everybody, but, these uninformed people are just talking about like how they're going to pick up deals at 50% of the price they're at today next year.
I'm not seeing them.
I mean, they're out of their mind. They're just out of their mind.
By the way, how funny, in your space, in the single family space, we're actually seeing a surging of home prices. So people are leaving the urban core. Austin, the median housing price just broke $375,000 And so it's certainly in markets like we mentioned, like the Nashvilles, the Raleigh, Charlotte, Florida, Phoenix, these growing
you can
cities.
Just say the Sun Belt and the North and the Southeast,
Sure. I mean, housing prices are going up and rents are still increasing. Cap rates, if anything, are staying stable and rents are coming down, which that by itself is a little bit of an anomaly. For rates to be this low, we should see cap rates compress a little bit, and they're staying a little bit stable. In some instances, they are compressing. But you have to look at things more than ever on a case-by-case basis, on a corridor-by-corridor basis. When you do your underwriting. But I'll tell you, from a financing standpoint, there has never been more accretive financing on the agency side than there is today. I mean, I just got a quote for 2.6%, 12 years with Fannie Mae with 5 years of IO. I don't know how, it's, pretty
clearly
unbelievable.
Below the rate of real inflation. And
it's effectively free money. I mean, and
it's not free. They're paying you to take it.
Literally. Yeah, I couldn't agree with you more. So we're seeing great opportunities, but what I've told folks, they're like, oh, so you're getting this, huge discount. I'm like, no, I'm actually just buying deals from guys that I thought would never sell. So there's a gentleman in town, pretty famous guys in his 70s, owed a bunch of stuff. And, it was always like, oh, I'll just pass it on to my kids. And so we're paying market. But the fact that he's like, you know what, I'm tired of this. I don't know if I want to deal with this. I want to go to my house at Martha's Vineyard. Here's what it's worth, Ari. I'll sell it to you. And so the fact that you're getting it is the deal. But, I'm not seeing this distress in the multifamily sector. I mean, hospitality, retail, we don't play in that space as much. And I read the news, but, I'm sure there's distress there.
So there's distress in urban core markets in, the sort of the former, and I think it's former trophy cities, San Francisco, LA, New York, Seattle, even San Diego, I think.
Chicago.
Downtown, definitely Chicago downtown, Boston, any of this downtown stuff anywhere, right? People don't want to be in high density. They don't want to live in a riot zone, and there's this flight to the suburbs, right? These suburban markets are really strong. So that's interesting. Now, I want to ask you about, some predictions of what you think is going to happen next year or the year after. But before we do that, let me just show you something. I'm going to share my screen here, and I want to show you something because I think, Ari, this might represent shadow demand, which is sort of an interesting concept of these sort of unseen shadow demands. Can you see this chart?
I can.
Okay.
Wow.
Great. And this is shocking. And what this, if you're only listening on audio and not seeing this on video, which, it'll be on our YouTube channel too, the majority of U.S. young adults now live with their parents. This is at the highest point ever recorded, and we're going back 120 years, okay? When in the old days, people did live with their parents. I mean, even in the Great Depression in the 30s, there were fewer people living at home between 18 and 29 years old than there are today. That's absolutely amazing. During the Great Depression in the 30s, it was only 43%. Now it's 52%. During the Great Recession 10, 12 years ago, it was 44% is where the top number was. So, eventually these kids are going to move out. Yes. And they're going to need a place to live. So, this is a shadow demand for, a lot more demand for houses and apartments, right?
I love the way you explain that. And this is fantastic. This is fantastic data. And, another thing to kind of dovetail into it and emphasize the point is that millennials, and I kind of joke that I'm the oldest millennial. I'm 38 years old. So I'm like kind of the old and young guy both, right? Millennials rent as a general rule. And it's not that they don't have money necessarily. It's that the core values are different, right? You want to be out more. You change jobs more frequently than any, demographic in history. And so to further that point, when this demographic goes back into the workforce, once the fear factor has come and mom says, hey, you know what, honey, come home, stay here, do the college maybe virtually, or, come back to your bedroom. When that goes back into the market, I think it's going to create a massive demand for rental more than anything else, whether that's single family rental, a few folks living together, or apartments. But I think this is, a tremendous shadow demand. I hadn't heard that term before, but I love it, for apartment rentals in general.
Yeah. And just to give credit, this chart is based on Pew Research Center data. So it's really depressing, what are all these kids living at home for? This is just a sign of the times, but we are where we are, right? So interesting. So what do you think about, we talked about now, and we see prices increasing. We see huge shortages of housing, of all the commodities. Well, maybe not all, but a lot of them, core commodities to build housing and apartments. Lumber, huge shortages, with lumber causing the price of the average single family home to go up like $14,000 to $16,000 already, just because of the lumber shortage component only.
Absolutely.
And I think that will settle down a little bit. It's kind of bad right now. I think it'll improve a little bit, but still, I think the shortage exists for sure. But what's going to happen next year? What's going to happen the year after that?
I think it's a great way to look at it. And I always look at things as, you want the right answer, ask the right question, right? And I think in the short term, there's a lot of uncertainty. I get it. But, this is not the Spanish flu. This is not, there's the numbers are in of what we're dealing with from a COVID standpoint. And my heart obviously goes out to, the people that have lost family members and the suffering that we've seen. No question. I'm very sensitive to it. We know several people that have lost their parents. And, but at the end of the day, in Austin, Texas, Austin just became the 10th largest city in the U.S. And I speak from that vantage point. That's where I am, right? So it passed ironically.
But you do business in many markets.
We do. So we've done business in 38 cities, 12 states, 7 different asset classes, so we run the gamut. We own property currently in Phoenix and Dallas, Austin, we're around. But the net is, on a long-term basis, this is all a blip. This is a complete blip, right? And so we already were coming out of the longest bull market in history. You're already asking for a major correction in the stock market, irrespective of COVID, irrespective of the elections. PE multiples are trading at almost, crisis levels, regardless of anything. And even these trends that you're looking at, this exodus that we talk about, and I was joking the other day on Yahoo Finance that, California and New York are the land of the flea and Texas is the land of the free, and just, but the point was that exodus had already started. 1 million people left California last year. 150,000 of them came to Texas. So COVID has thrown gasoline on a lot of these trends.
It's accelerating the trend that was already there. It's accelerating it.
It's already happening. So when you look at a chart or you're a value investor, right? It's different if you're a flipper or market timer. That's just not my business. I don't understand it. I'm not a trader or a magician, right? Like, if we're buying something, we're renovating it, we're creating value, we're holding it, we have organic rent growth. We're creating value, right? Just like you are. So when you look at a 5-year, a 7-year, a 10-year trend, most of these things are effectively negligible in the grand scheme of things. I think you're going to watch the markets, probably come down in a lot of ways. You've seen the tech sector, really surge, very similar to 1999 in a lot of ways. So there's asking for a correction there. It's going to pull back a little bit. The Fed came out recently and said they're going to keep rates down till 2023. But what you said earlier, I really agree with, is these former trophy cities, the San Francisco's, the New York, the Chicago, residents are starting to think like, why am I here? Like, why am I in this, so I lived in Manhattan for many, many years. Our daughter was born at Lenox Hill, our oldest daughter. And so I have a great love for New York City and great memories of being there on Wall Street. But you're there and paying the premium. My dad called it elevation training. You're meeting the people. There's proximity. The banks are there. You're gaining all these connections. But when that ceases to exist, you have to say, do I want to pay state income taxes, federal income taxes, city income taxes, pay this much for my apartment? I mean, why am I doing that? Like, when I can have Google Fiber in Austin or Kansas City, it doesn't make sense.
It's just totally overrated, and the chart on the screen now, I hope you can see that, looks at Manhattan apartments, something that you mentioned earlier. Manhattan apartments see record loss in sales. Quick facts from the second quarter. So this is totally the most current data, right? Because it's going to keep dropping.
I mean, these numbers don't surprise me, but this is going to keep. I mean, these numbers, I believe that New York has seen its last day in that regard. I mean, I don't believe it'll ever go back to what it once was at its peak. I think there will certainly be corrections. I don't think it's going to be, disappear and turn into zombie land by any stretch of the imagination. But people don't see the value anymore.
Ari, what we've got to remember is and by the way, this chart on the screen is from CNBC, and let me just say it for the people only listening on audio, okay? So second quarter sales of Manhattan apartments down by, you ready for this, folks? 54%.
That's a crazy number, by the way. That's a crazy number.
That's shocking. That's shocking. It's not 20%. It's not, 30%. It's 54%. Total sales, the lowest number on record of only 1,147 sales. Now, this is the biggest city in America, okay, where you've got a population density of 27,000 people per square mile. Right. So only 1,100 deals happened, right? Median sales price down 18%. That's the number that is going to just dramatically compress, if you ask me. And this is just a proxy for any other city, okay? It's, we're talking about Manhattan because it's famous, but San Francisco, LA, where I grew up, Portland, downtown areas anywhere, Portland, Seattle, downtown San Diego, all of this stuff, Boston. I sort of wonder about Miami. I'm in Palm Beach, Florida. And I got to think it's going to happen there, definitely in the high-rise world.
Miami's a different animal. It's a
little bit different, I know.
It's a different animal because it's used mostly as a currency hedge from foreign investors. So you can't look at Miami as a typical American city. It's different rules. And there's, you watch it through different cultures, different, demographics have gone in there and bought it for different reasons than typical investing. And I got to believe.
You have that in New York, too. You have a lot of Russian and Ukrainian money.
You
in
do.
New York,
You do. Well, the old joke used to be on Wall Street, if you invest in Manhattan from overseas, you don't get fired if it doesn't work, right? Like you could kind of still you bet on Manhattan, it's like you're not going to get fired. But if you pick Houston and you were wrong, you're for sure gone. Which is, and that's all changing. And Florida, I'm so bullish on Florida long-term in general for a lot of the same reasons as Texas. The exodus of the East Coast is going to come to Florida. The East Coast has always had a friendly relationship with Florida. We know that. But look at your Naples, your Boca, Palm Beach. Fort Myers, forget about it. These cities are exploding, and for the right reasons, same as Texas, because there's jobs and there's fair weather climate and there's lower cost of living, and there's that actual, it's it's booming. I'm like, booming insinuates a bust. This is because the freaking job is there. This is because there's actual, sustainable infrastructure that allows a better standard of living. And I think it's important to make that dichotomy.
Right. Yeah. No, I agree with you. And you didn't mention, but you were mentioning it in what you were saying anyway, business friendly and also landlord friendly. So good places to invest. This chart is from Miller Samuel and Douglas Elliman. I had the CEO of Douglas Elliman on the show before, and she was talking all about how people are fleeing New York City. And, that's really against her own self-interest. I was pretty amazed to hear that from her. But, this is new leases plummet in the Big Apple, percent of year-over-year change in New York leases for May 2020 in New York City. Shows you Manhattan, Queens, and Brooklyn. Manhattan down 62%, Queens down 61%, Brooklyn down 54%. So it's absolutely shocking what's going on. Now, let's go to that other topic of what's going to happen next year, the year after. Look, no one can deny that this is certainly a very uneven situation. Some people are doing fine. Some people are really suffering. I don't hear much about this. But all of these commercial properties, Ari, that are in so much trouble, the retail, the office space, those are backed by mortgage-backed securities that finance those deals. And those are going to default. Those bonds are going to default. The securities are going to default. And that's a domino. The residential market, I don't think, has that problem to any great degree.
Now, they corrected a lot. They put a lot of risk controls in after the subprime debacle. There was a lot more risk controls that were there.
For the residential side.
On the residential side. And, because that's what pulled it down last. People are like, is it going to be real estate? Last time was because there wasn't risk controls in the subprime market. That was a different animal, right? At the end of the day, it's a game of musical chairs. Somebody's going to have to end up kind of, missing a chair. And when you look at the CMBS markets, they still are highly inefficient right now. And there's a lot of uncertainty. But to your point, back to the question of 1 year,
CMBS
2 years.
Commercial mortgage-backed securities.
Correct. Yeah. Yeah. So the bondholders. So, and effectively what that is for people that, are listening is the bank goes and makes a series of loans. They'll make 1,000 loans at X amount and they pool them together in what are called tranches. And then in those tranches, rating agencies will rate certain pieces of them and then they sell them in pieces as bonds and they collect, an interest rate effectively. So that's in a nutshell what a CMBS is, right? I think with retail, hospitality, and commercial is going to suffer longer. Okay. Because even it's going to be when the vaccine comes, not necessarily because it's solving the problem systemically, but just psychologically, it's going to give a lot of comfort because there's a lot of mental health issues, quite frankly, of people just having fear irrespective of the data. I mean, the CDC has been pretty clear that the numbers around coronavirus are similar to the flu. Is the flu safe? No, the flu's nasty. It kills people. I mean, every year people die of the flu. So it's going to take time, I think, psychologically for that to happen. But I also think there's a lot of pent-up demand of people wanting to travel. People are craving human connection. This thing of working from home. Jamie Dimon the other day said it very openly. Productivity has plummeted from people working from home. And so I believe in the office sector in general, this whole work from home forever thing is just completely unsustainable. Is there certain?
Really?
Absolutely. No question. And it's because as humans, we're tribal beings. Okay. We work together. There's a human connectivity. We whiteboard, we talk, we have this thing, we go to lunch together. You grab a soda, grab a beer, whatever there's something that happens, when you're together that creates productivity. But with that said, if you're a coder for Google and you don't require, if you're not on the sales side of the business, yes, could that part of the business, certain sectors begin working from home? Yes. But something that's very important to remember is the largest tenant in the office business, in the office sector back in the 80s and 90s were law firms. Okay. And law firms once became digitized, and the reason they were the largest because they had libraries. So they took all these different floors for the books, for research. But once that became digitized, there was a massive vacancy that happened. And it only took about 2.5 years for those vacancies to be filled back up. So I think you're going to see innovation. You're going to watch vacant office buildings converted some floors into multifamily, just like we saw when Sears started to go bankrupt. Folks came in and converted that into self-storage. Like you're going to watch innovation happen, which I'm excited to see. But longer term, I believe all of these sectors will be, and it's like retail. They said, the retail apocalypse. Well, you look at Amazon, the largest e-commerce company in the world, the largest acquisition they made of $13.2 billion was Amazon. It was a brick and mortar location, which I find to be a little bit Whole Foods. Yes, Whole Foods was their largest acquisition, which is, obviously founded and headquartered here. So the retail was this overcorrection. And now you're starting to see, before COVID, retail start to make a resurgence because people want an experience. They want to go out. Like my kids are still sad about Toys R Us. It wasn't that you can't buy the toy on Amazon, but we like to go to Toys R Us. Like we enjoyed walking down the aisles and having this experiential kind of thing. So
we get it. But bring that back to like what's coming, if you can.
What's coming is going to be long term. This is all fine. Is the short answer. I don't believe any of this is cataclysmic at a macro level. I think rents are going to grow, home prices are going to go up, people are going to travel again, hotels are going to start to see occupancy again, and over that longer term.
A lot of small businesses have closed.
A lot of restaurants are closed, but there also was too many restaurants. And I think that a lot of people then are going to so a lot of the restaurants here that we see in Austin as an example are doing phenomenal because they have great food. And a lot of this is capitalism. A lot of this is survival of the fittest. So some of these businesses that weren't run as efficiently should have been closed anyway. Back to that kind of COVID accelerating something that should have happened. I just want to make sure we're not mixing a business closing that should have closed 10 years ago anyway. And now they just got a kick in the teeth and it's gone. So we're mixing those things together.
Yeah. Joseph Schumpeter's creative destruction. That's what that is.
There
and this
go.
has accelerated that. And that's ultimately a good thing.
It's a great thing.
At the time, but it's a good thing overall.
Great thing.
Yeah. Because it makes the economy adjust faster. But it's really hard to see, Ari, how, what the conversions of, say, shopping malls will be. That's not easy to turn into much of anything else. Yeah, you could take the Sears and make it an Amazon distribution center, but what do you do with the rest of the mall? It's hard.
You also have to factor in population are growing in these areas. There's mixed use developments. There's a lot of things that can happen. It depends on what year we're talking about. If you say 1 or 2 years, I agree with you. I don't know what to do with that shopping mall. Over 20 years, and you look at the population growth of the cities in the Sun Belt, there's certainly going to be use for some of that space. For something of some sort. Maybe it's a rezoning, maybe it's, housing, but population growing at the rate that it is within those cities. And if you have a city like New York, of everybody leaving, you're arguably talking about, 20 million people, in the outer New York area leaving. That's a lot of people that need houses and places to be in cities that didn't have that type of population. So I believe it fills.
Yeah. No, I know it's pretty amazing. Well, wrap it up for us with just anything you want to say. Maybe something I didn't ask you. Whatever you want to tell the listeners and viewers.
I think we're all kind of news fatigued, and we're seeing all this bad news constantly of this is bad. And I'll be honest for us, this has been an incredible buying opportunity. We've expanded, we've grown the firm, we're buying properties. Things are going great in a lot of ways, meaning that, Edison would say, people miss opportunity because opportunity shows up in overalls. So it's more work. You're slugging through mud, but those that are going to go put in the work right now, I assure you there's a tremendous amount of opportunity to be had in a lot of these things, but you have to be a little bit long-sighted. You have to have some vision. You have to have some resilience. And, if you want to take the lazy, entitled approach, pretty tough time. But I've actually seen it to be a tremendous opportunity because most of the competition is asleep.
I agree. And they're going to miss the mark at all these people saying that, I'm waiting. I'm going to keep my powder dry until everything's 50% off. Folks,
that's just not going to happen.
That's just very unlikely. Yeah. And if it does happen, if stuff gets that cheap, it will be largely
there'll be bigger problems.
Well, hang on. It'll be because interest rates went way up. So people they're looking at the price and not the payment. People buy properties based on payments, not prices. And that's why, housing is actually cheaper now than it was in 2006 on a monthly payment basis. So yeah, don't miss the opportunity, folks. I totally agree with you, Ari. Give out your website or Twitter handle or whatever you want.
Oh yeah, sure. It's Rastegar Property. It's .com, or on Instagram. It's just @Rastegar, which is just Rastegar.
Good stuff. Ari, thanks for joining us.
Thanks for having me.
Happy investing. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.